Mahesh Patil joins us. Let's take our conversation forward. Mahesh, morning. Thank you for joining us. Mahesh, now is the real test when you have an internet company which is a loss-making company which goes public. It challenges the way how fund managers and how investors like you have historically valued companies based on cash flow, dividend yield, and intrinsic or enterprise value. How do you see, because of Zomato listing, the market proposition to value companies will change?
Yeah, hi. Good morning, Nikunj. So I think, Zomato launch, I think, is an interesting one. I think will be washed out because I think from a traditional perspective, you look at managers looking at cash flows and profits, and that's not how we have been valuing companies. But I think this is a new game altogether. And here again, I think we have also evolved, I think, and tried to create our own models to evaluate some of these companies where near-term cash flows are not going to be there. You have to look at much deeper into further down the line, say probably 10, 20-year kind of view, and then take a call on some of these names. So I think clearly we are also changing the way we are looking at some of these companies. And initially, I think very difficult to really put an exact science, behind this in terms of how to value it. But I think over a period of time, I think the market will evolve. And while we are positive on some of these companies because of the long-term growth prospects, clearly near-term, it will be difficult to really peg in a value over there. So it will be important to take some exposure there. And as you get more comfort, as you understand the company much more. And I think it is more about looking at the winners, who will be in this sector, because that is what will drive value over here, right? Because ultimately it's going to be the top one or two companies which will take up bulk of the value in each of these segments. So I think again within our team also we the convention analyst. We are looking at someone who can actually evaluate someone, because it's not the only IPO which is going to be there. There are going to be more IPOs which will be coming in the space. So from analyst perspective also, we are trying to build that expertise. Normally you will see that capabilities in some of the PE funds who take such bets in companies, where the future could be this thing, and the near-term earnings are not there. So I think we are building our capabilities over there, and we are pretty okay at looking at some of these names with a small exposure in our funds.
Mahesh, why have the numbers from Bajaj Finance or HDFC Bank pointing to stress on the retail side? And is this something which has caught your attention, that if the best manageable franchisees are going through pain because of COVID, are we looking at a big challenge coming in for retail dominated lenders or retail sales or consumer demand?
So I think this was to some extent expected because of the second wave, and the second wave has impacted actually much larger cross-section of the population. It also hurt in the rural India. So it was expected that we would see an impact. The key question remains that how things recover soon, right? Once the lockdown is lifted, how soon the recovery would be. So we have seen some expected stress in probably the SME sector, the unsecured loan, the microfinance side. So that was anticipated. And that to some extent is reflected in the numbers. I think market was getting slightly more optimistic about how the impact would be, and the stock prices were not reflecting that. But again, the way we look at it is that this is again a short-term impact, and companies, especially in the retail side, which have built strong capabilities in terms of underwriting, in terms of recovery, and are able to really reduce their costs through digital. I think those companies will again come back and bounce back. So I think I'm not really too worried about the numbers, what we are seeing in the first quarter. I think the overall retail sector would come back. There will be pockets, where there will be stress. So to that extent, I think one needs to really look at the portfolio mix of some of the NBFCs and then take a call over there.
Right. Where is it, Mahesh, that in the current market you're getting a little uncomfortable about the valuations that these spaces or pockets or sectors may be quoting at currently?
So, yeah, I mean, if you look at the broader market itself, it's quoting at valuations which are much above the long-term average, and that's been the nature of the market, not only over here, also globally. And that is to do with two factors. One is easy liquidity, low interest rates, and also the fact that some of the sectors are probably at earnings which are more depressed. So market is willing to look at slightly beyond the current earnings. So that's the broader trend where overall the valuations are much higher than the long-term average. Within that, if you look at sectors like, for example, a few sectors which have done significantly well or got re-rated are the chemical sector, especially specialty chemicals, considering what the valuation used to be in the last 4-5 years. I mean, there has been a material increase in the valuations. And that gives some kind of a discomfort over there because while we have seen a good tailwind in this sector, and the numbers have also been good across the board. But again, the sector can see some volatility, okay, depending on how the pricing environment moves. So clearly, that's one sector where the valuations are at probably 2 standard deviation above the long-term averages. Apart from that, I would say that the valuations in most of the sectors are slightly above, but not really into the zone where one would be too uncomfortable.
Fair point. Okay, just taking stock of where the market is currently, it's a better day for the broader end of the market. That's where you've got a good 118 stocks standing to the advances, and it's really emphasis all the way, reacting to its numbers, holding up a solid 10% as we speak right now. Mahesh, it's been quite interesting, the performance across IT. While it was a muted quarter for TCS, Infosys, some of the mid-cap IT companies like LT Infotech, Emphasis, what have you, they came out with a stellar performance. And then, of course, HCL Tech was a different kettle of fish altogether. Would you say with this divergence will also come valuation differentials within IT? And is there a higher chance of mid-cap IT to oversee what large caps are going to do from here?
Yeah, so there's no doubt that we've seen that the whole tailwind in the IT sector and the move towards digital has benefited across the board. I mean, not only the large cap companies, but also the mid cap and small cap, especially companies which have been really focused on basically on the digital side. And that has led to a larger re-rating in the mid-cap IT names. I mean, traditionally, we have seen that historically, mid-cap IT has quoted at a significant discount with the large-cap IT names. And that discount has narrowed significantly. Now, it all depends from here on, I would say it will be more company-specific in the mid-cap IT sector. Companies which can continue to exhibit a stronger
Hi, Mahesh. Good morning. This is Mubina as well joining in. All right. Okay. I'm afraid we've lost Mahesh's network over there. But I just want to flag off the banking index actually, and that was going to be my question as well for Mahesh. It's in the green, of course, as are most of the sectors. But again, another bout of underperformance coming in from the banking space. So, while most of the indices like metals, oil and gas, IT, etc., they're all gaining at least by 0.5%. The benchmark is higher by 0.25%. The Nifty Bank is barely eking out gains of 0.1%. So it's just a flattish day once again for the banking stocks yet again. And I think we managed to, reconnect with Mahesh. Hi, Mahesh. Good morning. Banking has been an underperformer this week, this year, last year, even though when we say that, okay, the India growth story could perhaps be reflected by banking stocks, that's clearly not been the case. And now to add to that, in this quarter, many of the banks, the most prominent ones as well, have felt the pinch of the second wave. What's in store here for India's BFSI space?
So the banking sector, if you look at, there are two parts to it. Okay, one is the retail banks and the corporate banks. So this time around, because of the COVID, we have seen some impact on the retail credit. I mean, NPAs, which had seen a very good cycle in the last decade, that has clearly been impacted. On the other hand, if you look at the corporate credit cycle, which took a beating around 2-3 years back, and we saw large NPAs over there, that is actually behaving much better. We have seen during this whole pandemic, the large corporates haven't been as impacted. In fact, some of the sectors like steel and other which were in the downturn have actually benefited out of that. So we've seen the corporate banks actually doing much better in this last 1 year, and where the valuations were also very depressed and below the long-term average, and that's where the re-rating potential has been. On balance, I would say that there was, the COVID impact definitely has been there, but a lot of banks have taken large provisions last year itself. And to that extent, I think they are pretty well covered. There has been credit demand has been fairly weak, and we don't see that picking up immediately. But as the economic growth bounces back, as we see investments also picking up, and we are pretty positive on that, we take a 2 to 3 year view, I think credit growth will also come back. And I think except for this quarter and probably another quarter where you will see some impact on the NPAs because of the second wave, and assuming that we don't have a material third wave coming in, and that looks a possibility, like looking at the fact that how things are progressing in terms of vaccination. So I think given that, I think the banking and financial service sector should do reasonably well from here on, and should be a good play on the economic recovery. And as you rightly said, the valuations in the sectors are not really that expensive compared to its historical average. So we're not buying something which is already expensive compared to most other sectors as this stands today. So as long as one is betting on the right bank with a good mix of retail and corporate banks, which are pretty well, I think digital is also, I think bank adoption of digital will be critical for banks in terms of bringing their cost down and also getting market share. And we're seeing that with some of the other IPOs coming in on the digital side. So banks which are well positioned on that should probably get re-rated further from here. So on whole, I think we are still positive on the sector. I think barring this one quarter kind of an impact, I don't see any material downgrades to earnings to the banking, at least with the large banks.
Okay, all right. Look at the mid-cap IT names. Persistent Systems has hit a record high. Emphasis as well has hit a record high. And, these are really, every quarter we see these mid and small cap IT companies come out with their numbers. The street rewards it, with this nice pop that we are seeing, just like we are seeing in today's trading session as well. That really seems to be the flavor. The other question I wanted to ask you, Mahesh, is metals. That's been the other space that has done extremely well since March 2020, outperformed several other sectors, out of the blue. But now with stocks at, stocks reaching close to 8, 9, 10 times their PE, they are definitely higher than the historical average in terms of valuations. Would you say that these valuations that have been ascribed currently are at the upper end, and from here maybe there's limited room? Or do you think that 8, 9, 10x is an extremely modest figure to ascribe to a commodity company in today's day?
So interestingly, when you talk about valuations over there, while the stock prices have no doubt gone up multifold in the commodities or the metal space in particular, but valuations are not actually that expensive as it looks like, because see what has happened is that prices have gone up because there's been a significant deleveraging which has happened in the commodity space because of the strong cash flows these companies are generated in the last 1 year and probably likely to generate in this fiscal year also, looking at where the prices are. What has happened is that debt has come down materially. As a result, even in the enterprise value, even if you keep it the same, there can be a significant increase in the equity value and the stock prices. So that's one part, and that's how one should be looking at it. Secondly, I think the overall rally in the increase in the prices, what we are seeing is while not sustainable, and one could see some correction over there. I think even if they correct from these levels, I think they are still going to be much higher than what we have seen in the earlier cycle, because the whole demand-supply equation, because there are a lot of production capacity which has been cut down or pared down in China, and we're not seeing any large capacities coming in because there have not been big investment which has happened in the sector in the last few years. So given that, I think prices should remain fairly higher than the earlier cycle, though they would come down from these levels. And those, if you look at those numbers, then the companies should still do fairly well from here. Obviously, the upside from here would be fairly limited considering the re-rating which has happened. So I think one need not be too much perturbed about the stock price increase. We have to look at in terms of how the enterprise value of these companies has gone up in line with the underlying EBITDA, which has grown. And I think if you consider that, then I think the stocks look to be okay over here. Though I think in the near term, the stock prices will be driven more by the movement in the metal prices, and which are currently seeing some correction, though we don't see them coming down materially from here. So I think we are not too negative on that space, despite, as we talked about, stock prices going up, but we are monitoring that space closely because this is a cyclical sector and we need to really monitor how the situation changes on the demand supply side.
So Mahesh, as we look into the next 12, 18 months, where do you think the surprise could come from on the earnings front? Because cyclical recovery is something which markets are pricing in. IT expansion is something IT companies are capturing. Consumer coming back is something consumer staples are capturing. And what I'm trying to understand is that incrementally for markets to go higher, you need a surprise or you need a disappointment.
Yeah, so I think the surprise probably could come in again. It has to come in from the cyclical side, because while the market is factoring a recovery over there, it's not to that extent, because we've seen the cyclical, especially whether it is industrials or even to that matter in the banking and financial services sector or in the auto sector. I think there is, whenever the recovery comes back, if it is strong, there is a significant operating leverage, okay, which kicks in. And you can, as I mentioned earlier, you can see a significant deleveraging, which has already happened. So, because I think the consumer sectors, we haven't seen too much of a decline, and there the variation is not going to be too much. Even in the IT sector, again, which is a large sector, the variability in the earning is very less. And we are talking about earning surprises by around 1-2%, and that is cheered by the market. So the bigger surprise in terms of earnings will have to come from the cyclical, and it has to be the domestic cyclicals. I think the global cyclicals have also to large extent played out, whether it is metals, okay, what we've seen already, the earnings growth has been fairly good. And from here, one can't expect any major surprise. So it will come down to sectors like auto, for example, which has seen a significant impact of volume as well as margin pressures. I think that if that bounces back, I think that could surprise. It could be the capital goods sectors and the and also to some extent the consumer discretionary side overall, or the consumer durable space. So that's where I think the earnings surprise can be, and then that can take the market higher. I would agree that the market is discounting probably the next 1.5 years earnings, but I think going forward for the market to do well, we don't require any big earnings surprise. I think in the earnings growth trajectory, say after FY22, right, is somewhere in the mid-teens. I think then also the market should be doing well from here. And that's not at all order, right? Considering the fact that we've seen earnings have been suppressed now for the last 4-5 years. And we are seeing some buoyancy coming in. I mean, in fact, even last year in FY21, we've seen the Nifty earnings actually grew at 17% when there was an overall contraction in GDP. And this was the highest earnings growth we saw in the last 5 to 6 years. So I think somewhere around mid-teens earnings growth should be good enough for the markets to really continue to do well over a medium to long-term perspective.
Okay. Mahesh, fantastic to have you back. So good to connect with you, and certainly hope to see much more of you going forward.